Okay, so let us get into this too early, too late fix pack. So solve two of the most common entry timing killers. Number one, entries that happen too early. Either you don't have any real confirmation, which we just went through so much confirmation, ways to look for confirmation. And number two, entries that happen too late after the move already happened. Either if you hesitated or you overanalyzed and you just didn't enter on time. So these are the main two reasons we can either, miss our perfect entry timing. You're either too late or you're too early. Now it's just about finding that sweet spot in between. Develop instinctual timing on when to strike or when to hold. So the key to this is developing this timing. If we can learn to identify the timing, the correct timing, where we're not too early, we're not too late, and we're just in between early and late, that is going to be our perfect entry. But going through the reasons why we could be entering early or why we could be entering late could help you maintain that balance and calibration in finding that perfect timing. So how to fix early entries? Entering early is one of the biggest reasons traders fail in their trades. They fail to wait for the right confirmations, which are fundamental for getting your entry timing aligned. So the key to this is waiting for your right confirmations, which can require patience and it can require you to stick to the rules and become very mechanical with your trading. Like I was breaking down now, the things we look for, those are our right confirmations. So if we don't get 1, 2, and 3, step 1, 2, and 3 that we just went through, then we're not going to enter. So it's really important to wait for these confirmations and then to keep this whole process very mechanical, because the reason we enter early is because we're entering on emotion. We either FOMO, we fear of missing out, or we got a feeling, we saw a certain candle, an inducement, which tricked us, because the market makers are creating trickery in the market to trick you, to make you trade emotionally. So the more mechanical we can keep this process, the more we can stay out of our emotionals, which take over. You've probably done this before. You see price tap a key level, you instantly click buy or sell. You expect it to reverse, but instead price blows straight through it. Why? Because just touching a zone is not confirmation, it's bait. So this can be one of the reasons you're entering early as well. What is really happening at those levels? Smart money doesn't react on the first touch. So a lot of times price will come to a key level and you might just enter your trade just because it came to a key level without waiting for the proper confirmations to follow. So the smart money is setting traps for you. What they're doing instead is compressing price into the zone, building liquidity from impatient traders, sweeping that liquidity to grab stop losses, and then only displacing in the real direction. So price is going through a certain phases. And if you're able to identify these phases or movements, it can help you from entering these trades early. If you're entering as soon as price taps the zone, you're entering before the trap is even sprung. So we have to keep in mind, we have to know beforehand that the market is designed to trap you. It's designed to trick you, and it's designed to set up bait to steal your liquidity. If we know that is the case, then we want to anticipate that happening first before we get into our entries. When I started trading as well, price would come to a key level and I would just hit buy or sell just because it came to that key level. And 90% of the time I would be taken out of the trade, because the key is to wait for the bait, to wait for the trap to be set and for it to be triggered, and then to enter afterwards. And these rules and criteria that we've set are designed to help you enter afterwards, to keep you safe. But I'll go through more details of this model, how it works, and how we can avoid it. So why touch then enter fails? When you enter just because price touches a zone, you're skipping the most important parts of confirmation. There's no compression. So compression is a sign of pressure building. The market is too clean, too smooth. You have no evidence of manipulation forming. Compression is very important. And this is what shows us the manipulation. Price is going into a contraction and it bursts out, forms the manipulation. So you always want to see compression. And this is one of the reasons we wait for the failure to displace in the break of the CISD, because that's usually after the compression. There's no liquidity taken. So equal highs or lows are still sitting. Retail traders haven't been wiped yet. Smart money hasn't created a reason to enter. So for smart money to enter a trade, they have to wipe out the liquidity from the retail traders. They have to create a trap. They have to set up a scenario that allows them to take your liquidity, to steal your liquidity, so they can enter their massive position sizes. So most of the time, this has to happen first before the price will reverse direction, because the market makers are directing the market. They're moving the market. So we have to align with their strategy. We have to align with their processes. And the more we can understand what their strategy and what their processes are, the easier it is for us to see it happening, for us to observe it, so we can wait for the proper confirmation, so we don't get caught in the trap and we just simply enter after the trap. And no displacement. There's no real shift in control. Price is just testing, not moving with intent. You're basically guessing. So you see, we want to see compression, we want to see liquidity taking, we want to see displacement. These are key aspects that we want to see, that allows us to understand and interpret that the market makers have set their trap, and the trap has been passed, and we can enter after that. If not, you're just simply trading into a trap, which happens to most traders. So what to wait for instead? What we want to wait for is, we want to wait for liquidity sweep. This is where price grabs the stops above or below a key level, and this shows manipulation has occurred. This is one of our key criteria that we look for our entries, and you'll see our entries, our entry signature and our entry model, which I shared with you, it's going to be tied into this formula. So just by simply following that, we avoid all of this. But I'm still going to go into all the details of this so that you can understand the mechanics of what is happening, so that you can understand psychologically what is going on and how to avoid it. So we wait for displacement. It's either a strong, fast move in a new direction. You're not trading a bounce, you're trading momentum. So this gives us a clue of who's in control of the market and when the market is shifting from bullish to bearish, or from bearish to bullish. We're looking for a change in state of direction, or a CISD. On the lower time frame, you see a clear CISD. This is giving us confirmation. This confirms the direction is shifting. And another thing we look for is a CISD model, which is a new model that I've been working on, which I'll go into some details now. This is observing for compression, which builds the tension. We're observing for inducement, which is basically the bait that's set to capture the retailers. We're looking for a sweep, which clears the board, displacement, which shows intent. And when this sequence completes, that's your signal to enter. So I'll go over the CISD model shortly and show you exactly how that ties into everything we're going through. The CISD model, and don't confuse, we've got our CISD entry, but we've also got our CISD model, and it's all tied into the same thing, just finding new ways to make it easier to understand this process. But what I figured out is the CISD model equals the real confirmation. So what CISD stands for is compression, inducement, sweep, and displacement. This is the signal smart money leaves before a real move. So if we can observe all of these factors are occurring, that gives us a surety or a safety to know we can enter the trade without getting caught in this manipulation cycle, without getting caught in the trap. So the CISD model, I'm going to go through the bearish first. You can see price comes to a key level, and you'll also notice that this model is tied into our entry signatures that we went through in the beginning, step 1, step 2, step 3. So, I mean, just following those keeps you safe, and basically it follows the rules and regulations of this model. But basically what happens is price comes to a key level. Oftentimes it's not just going to hit that key level and then it's going to reverse. There's going to be a certain scenario that's going to play out at that key level, because we know at key levels, this is where we have resting liquidity. So we know at these key levels, it's where this manipulation act is going to unfold. So if we can understand that at each key level, there is going to be a manipulation act, if we can understand what that act is and the mechanics of that act, we can anticipate that is what is going to occur at these levels, and then we can just watch it unfold, and we can enter at the safest aspects of it. So you'll see price comes to our key level. Oftentimes when it comes to a key level, it won't touch exactly that key level. Sometimes it will, but when price comes to a key level, it's going to interact exactly at that level, or it can be a little bit before, it can be a little bit afterwards. The key levels are just a zone that we look to use in a roundabout fashion. So you see price comes to a key level. Oftentimes when it comes to a key level, it goes into compression. So you'll notice compression is our first part of the CISD model. Compression is when we start getting these low highs and high lows being formed. If we're looking at the chart, it's also known as consolidation or contraction. Price is coming to a point, then we're seeing this contraction or compression, which is letting us know the buyers and the sellers are actually neutralizing. They're actually becoming less volume is happening in the markets. And then price starts to form these equal highs and equal lows, which is the setting of the trap. So this compression is forming equal highs and equal lows, and then inducement is going to occur, which is the second part of the model. Inducement is when the market sets bait. It basically tempts you. It makes you believe it's going one way when it's actually going another way. So it causes you to enter the trade on the wrong side of the market. So what it will do in this scenario, it'll either cause a fake change of character, a chalk. It'll form a fake fair value gap. So what it'll do is it'll form this contraction or this consolidation, and then price will just break down, either break a high or a low, and then everyone thinks the market's going to go down because it will use either a big red candle to drop. This big red candle will drop. You'll see that big red candle, and for the FOMO traders, they will just enter their sell because they know at this region is where they're looking for a short. So inducement is basically when the market maker sets up a signal that makes you think now the market is going to go down. So then everyone enters their short, and then what happens? Then the sweep will occur. And then the sweep will take out all those people who entered their short here, because if they entered their short here, they would be placing their stop losses somewhere around here. And then there would be this sweep that would take place with aggression. It would sweep, it would clear out all these stop losses for these guys who entered early. Because remember, this is about avoiding entering early, because if we enter too early, we get caught in the trap. And then this displacement, basically, which causes this manipulation move, causes the sweep. And then we get the displacement down. So we get displacement up, displacement down, which is that aggressive move of manipulation that I mentioned before. Breaks the CISD. And then when we see the manipulation down, this is showing us the displacement, which is the third part of the CISD. So we want to see compression, inducement, sweep, displacements. Once we have those four aspects complete, we know that the manipulation act is complete. And sometimes, as I've seen, sometimes this might happen even twice. Doesn't happen that often, but I've seen the manipulation act will happen, then it'll happen again on some tokens that are just highly volatile. But majority of the time, this is only going to happen once. But if we can understand this model, then we can understand what is actually happening at these levels. So we can wait for the act to unfold. And it's pretty amazing when you see it unfolding and you can actually observe the details of it. It gives you some kind of strength and confirmation and confidence that the market is not happening in complete randomness, that there's some algorithm, some order, and some structure to how it works and how it moves. And this is one of the scenarios I've seen repeat over and over and over again. So if we can understand it, it can really keep us safe and get us to enter in the perfect timing. So now we've got the CISD model bullish. So there's the bullish and bearish version. You can see over here, we've got our key level. Price comes to a key level, and then it goes into this manipulation act, which unfolds into this CISD model. You see, we get this contraction. So the first thing you're always going to see, price is going to go into contraction. Price will never hit a key level and then just suddenly reverse, unless it's a very manipulated asset, like where there's crazy amount of manipulation. But majority of the time, price will come to a key level and then it will start forming contraction first. So you've got time. When price comes to a key level, you've got time. It's never just going to hit the key level and then reverse like with lightning speed and you're going to miss it. You've got actually time for this act to play out. It'll come to the key level. When it gets to the key level, it'll go into contraction. And at the same time, it's going to be setting up the inducement, which is the trap, to make you believe it's going one way when it's actually going another way. So it'll go into contraction, and then all of a sudden, one big candle, bullish candle, will shoot up, and a lot of market participants will see this big green candle, and then they'll enter. They'll just buy. They'll be like, "This is the move." They'll buy. This is where the market is bouncing. They'll buy over there. Then suddenly we get this sweep, this aggressive sweep, which will sweep down and it'll clear out all those early traders. So the market makers are actually relying on this act, on these early traders, so it can steal their liquidity, so it can fill their positions, so that when their bags are full, now they can move price and they can start taking profit off of their positions. So you can see it'll create the setup, it'll induce everyone to buying, and then it'll suddenly sweep, it'll clear out all those buyers, and then it will go into displacement, break the CISD, and that is your time to enter. So you can see how this entry model coincides perfectly with our step 1, step 2, and step 3 that we use to enter our trades, with our CISD entry and our fair value gap entry. We're waiting for this to happen first, and then we're entering the market. So we know we've skipped over the manipulation, we've skipped over this whole process, this whole act, and keeps us safe on the other side. So this is something that really, really changed my trading and gave me a different insight into what is actually going on in the process. And the way I've drawn it here, it's not always going to look exactly the way I've drawn it. Sometimes it won't look as neat as this, but it's just understanding the process. The details of how it unfolds might change a little bit. Sometimes there might be more consolidation. It might change a little bit here or there, but it's understanding that this process is going to unfold majority of the time when price gets to a key level. And knowing this is going to happen majority of the time stops us from simply just entering when price comes to a key level and then just hoping that's all the best. Here we've got some kind of logic, some kind of mechanism that we can expect to occur, and then we're just waiting for it to unfold, and then we're just entering mechanically based on our rules of entering at the right timing. Smart money doesn't move on your first candle. They build traps and then they spring them. So just got to anticipate that you want to wait for the trap to unfold first, and then you can get through the trap safely and then get on to the other side.